You ever hear your lender throw out a term like your LTV looks great and wonder if you should be proud or concerned? Well, today we're going to be breaking down one of the simplest, most important numbers in real estate, your loan to value ratio, or, well, LTV. And trust me, once you understand it, a lot of the mortgage world suddenly, well, makes a lot more sense. Hey everyone, thanks again for tuning in to 2 Minute Tuesday. In this series, well, I pull back the curtain on real estate so you can make smarter, more confident decisions when it comes to buying or selling homes. So if you enjoy these quick breakdowns, be sure to like this video and subscribe so you never miss an episode. And besides, it really does help the channel and we thank you in advance. So, what exactly is loan to value ratio? Well, in plain English, your LTV tells the lender how much of the home's value you're actually borrowing. It expressed as a percentage, and it plays a huge role in, well, you guessed it, your mortgage approval, your interest rate, and whether or not you need things like mortgage insurance. The formula, it's quite simple. Loan amount divided by the value of the home. That is it. But the impact that number has on your loan, well, that's where things get interesting. And let's put it in a real world example. Imagine you're buying an $800,000 home and you're putting 10% down or $80,000. This means, well, the loan amount is $720,000. Now divide that $720,000 by $800,000 and your LTV is 90%. Now to a lender, well, that means you're borrowing most of the home's value. Now, flip this scenario. If you put down $160,000 down, your loan is $640,000, your LTV drops to 80%. The lower LTV usually means, well, better interest rates and no mortgage insurance. Friends, it's not magic. It's simply less risk for the lender. Here's another example that trips some people up. The value the lender uses isn't always the purchase price. It's often based on the appraisal value. So if you're buying the same $800,000 home, but the appraisal comes in at $785,000, suddenly your down payment represents a smaller percentage of the home's valuation. Now that bumps up your LTV, which can affect your rate or require you to pay PMI until your equity increases. This is why, well, appraisals are such a big deal. They can change the financial math even when the home price hasn't changed at all. So why is this all important? Well, it's simple. Understanding your LTV empowers you as a buyer, friends. It helps you know how much to put down, what kind of loan options to consider, and how to position yourself for the best possible rate. It also helps you avoid surprises during the mortgage process. Now, lenders love lower LTVs because, well, it means lower risk, but it does not mean you have to put 20% down. Plenty of buyers use 3, 5, 10% programs successfully. Now, what matters is understanding how your LTV fits into the bigger picture so you can make decisions that align with your goals. And as you start planning your home purchases, you talk with a realtor and lender about how LTV affects your specific situation. Everyone's number, looks different. And a quick conversation can save a lot of stress later down the line. And of course, if you have questions about LTV, friends, drop them in the comments down below. I'm always happy to help you cut through the noise and understand how the stuff really works. And friends, that is going to be it for this episode here. Thanks again for watching this 2 Minute Tuesday. If you happen to be in California looking to buy or sell, have some questions about the whole process, give me a shout. Would love to sit down and chat with you. I'm a real estate agent right here in Orange County, California. And before we go parting ways, if you found this helpful, make sure to like this video, hit the subscribe button so you don't miss any upcoming week episodes where I break down another key piece of real estate puzzle. Friends, that's all I got here. I'll be shutting off the cameras and I will see you in the next video.